Hello, sort of a crazy day in markets, which is not, I guess, so abnormal, but nevertheless, thought I'd do a very quick video slash podcast for you to get some perspective on where we find ourselves, what it looks like, and just some of the things that we're focusing on here as we move forward. I'm going to share my screens just because it's easier for me to point out important levels of market movement and confluence that's going on, not just inside futures and cash markets, but to get a glimpse into what we continue to see happening in macro. And when I say macro, I'm just talking about global conditions as it relates to economic activity, inflation, things of that nature, and how markets are reacting to it. Things like the bond market, the currency markets, oil, commodities, things of that nature. So let me share my screen here very quickly, and I will give you some perspective on exactly where we're at. So let's see here if I can get the technology just right. It will be okay. So here we are with this is the dollar. I'll give you a view of the dollar real quick, just because I talked about macro a moment ago. But if we're looking at the US dollar index, symbol DXY, what you can see is that it just continues in its bearish trend. It is in a trend that over the past 3 months is it's just in a downward movement. You can see it, right? Some of that could be due to the effect of the Federal Reserve expecting to cut interest rates. More likely than not, that's the pressure that it's seeing. Some people would blame it on them devaluing the dollar by continuing to liquefy the system with different forms of monetary easing, treasury buying, manipulation, call it whatever you want. But at the end of the day, what we're dealing with is just simply the fact that we have a bearish dollar. And that's fine. That doesn't worry me a whole lot just because there is also an inverse correlation. And I wrote about this a little bit in one of my morning notes over the last week or so, where a bearish dollar is actually not a terrible thing for both stocks and bonds because it's developed this negative correlation on a very short-term basis. And that tends to move into a longer-term cycle as long as the shorter term holds. And so far it has. So what does that mean? It just tends to mean that when you get a dollar down move, it becomes a tailwind to both stocks and bonds versus a headwind. That's really all that means. Does it mean that if the dollar goes up, markets can't go up? No. Does it mean if the dollar goes down, markets will go up? No. It just acts as a potential tailwind behind how this whole thing works. So let's flip over real quick to the S&P just so you can kind of see what happened today. And what was very interesting is that intraday, like early, right after the CPI report came out, and the CPI was pretty much a nothing burger. You didn't have a lot of activity in a lot of the details. The highest degree of inflation actually came from auto insurance, which is interesting and terrifying and terrible all at the same time because most all of us are, of course, buyers of auto insurance. So we got to deal with it. And intraday, the S&P was down about 1.6, 1.7%. And what I want to point out is this spot right here. This spot right here is trend, right? 5,400 is trend for the S&P 500 cash market, and it got down to 5,406 spot 96. Couldn't get all that much closer, but it hit it and it bounced. Now, here's what's interesting about that. That tells us there's some strength behind it. This great big green bar that you see is volume. This is a good amount of volume for the S&P 500 coming in, right? There's nothing wrong with that. That tells us that was a pretty strong move. Now, we were 100% invested going into today. We were 100% invested yesterday when markets were up 45 basis points. We were 100% invested the day before that when markets were up 1.16%. So we've been invested 100% over these 3 cycle days. Our models cut us back slightly today going into the close. Now, does that mean that tomorrow's a down day? No, it doesn't mean that at all. It just means that the modeling was signaling that something was happening within options flows that suggested perhaps we could see a bit of a sideways to downward reaction tomorrow. Tomorrow's the PPI data, producer prices. Maybe we see that producer prices have ticked up a little bit, and so maybe the expectation that inflation is dead is not there. Now, could markets react positively to that? Maybe. Maybe markets think, well, the Fed's going to cut rates harder if we see some inflation. Maybe if we don't see that inflation, markets don't expect the same rate cuts, and then you don't get as much of a response or reaction. A little maddening, right? I don't frankly care about any of that. To me, that's just noise. That's all that is. It literally is just noise, and I truly just don't care about it. I don't care about it. I say that flippantly to some extent, but it's not the overarching perspective that we use to try and position ourselves. This is what we use to position ourselves behind the fact that our modeling and coding, machine learning, and everything that gets built into the systems are what drive the portfolio allocation decisions. And so the fact that we hit trend on the S&P 500, held it, and moved higher under higher volume is a good sign. Now, this white line here, this is what we call trade. Now, these levels, again, just as a reminder, are nothing more than the rate of change, calculus here, the rate of change of price, volume, and volatility combined over a period of, for trade, less than a month, for trend, more than 3 months. And why that's important is because the rate of change of those things is really what generates the followers of both trend and momentum. And so therefore, when we have something like a market that busts above this trade level, that's a huge indication that something more likely than not good is happening with price as it moves higher. Now that trade level, which you can see right here, is literally like 5,500, 54.97, 54.98, call it 5,500 for round number purposes, right? That now is support. And so if markets pull back to that support level, it would give us an opportunity for our more aggressive accounts to add back some leverage. So while we were 100% invested into today's move, as far as allocations for equities are concerned, our more conservative to moderate modeling is never 100% allocated to equities, ever. The most that we'll allocate would be maybe 75%. And I think going into today, we were about 71% on those more moderate modeling systems that we use for clients. And the most aggressive accounts, of course, will use some leverage when appropriate, according to what we see happening within the confines of the options market, the flows, the machine learning, all that stuff that goes into it, right? And so ever since the S&P 500 broke down from this trade level, we've been in a position where we've just been very, very careful about attempting to add any leverage back in. And the fact that we hit trend, bounced back above on strong volume now increases my confidence that more likely than not, this market's going to hold up. But September is a crazy month. September historically just, well, sucks. Especially the back half of September. It's seasonally, it just has a terrible, terrible return profile. And so we want to be cautious with that. The other thing that has kept us out of leverage is this here. This is our volatility indicator. And ordinarily, when it spikes like this, it gives us an opportunity to say, okay, here's a good spot for us to add back some of that risk. This is an oversold indicator. It just is a confirmation of this volatility of increasing some of our risk. We didn't get up to that spike, and we didn't get an oversold signal. So that's what's holding me back from our more aggressive, most aggressive accounts in terms of adding back some of that volatility, or excuse me, adding back some of that leverage to increase potential returns. We still have in this bull market months like October, November, December, which seasonally speaking tend to be really, really, really good. So there's an awful lot of opportunity for us to do some catch up, for us to increase returns in portfolios, and just put us in a good spot going into the end of the year. And so therefore, we're just going to be patient and make sure that we're not jumping the gun or chasing or doing anything goofy. We're going to be careful about how we handle the day-to-day activity in these markets. Real quickly, I'm going to show you the Nasdaq and what's different about the Nasdaq and tech in general is the fact that it has not broken above this trade level. It's close. It literally closed right on it, right? It closed at 17,395.53. The trade level for today is 17,405.89. Didn't close above it, right? Didn't get an oversold signal, don't have a top end spike in the volatility metric. So the NASDAQ looks different, right? The NASDAQ is acting different. And some of the biggest players within the NASDAQ continue to be NVIDIA, well, the Mag 7, they call them, right? Apple, Microsoft, Netflix, Google, right on down the line. And so therefore, we're just continuing to look at this and say, okay, well, maybe we should continue to be just a little bit cautious. One other thing, this is an equal weighted S&P 500 fund. In other words, it takes out of the equation an overload of names like NVIDIA or Apple or Microsoft, things like that, right? Obviously, the biggest companies control the S&P 500's movement. And the biggest of the big is, of course, NVIDIA. So as NVIDIA does, to the S&P 500 tends to do. And so therefore, just a real quick look before we jump back to RSP. This is NVIDIA. NVIDIA was up 8% today. That's a lot, right? And it closed above trade. Hey, great news. Huge volume today. Hey, great news. Volatility metric didn't get to the August 5 bottom, but it rolled over. That's good news. We didn't get an oversold signal, but it's close. Also good news. Could NVIDIA be on the turn now and ready to spike itself higher? It could. Absolutely, it could. If it does that, the S&P 500 is going to get drug up with it. But for the time being, RSP, which is, again, the equal weighted S&P 500 fund, this thing didn't move much. It was up 5 basis points, 0.05%. Okay, that tells me that there were a lot of other companies in the S&P 500 that were down today. Okay, what do I make of that? Nothing yet, right? Nothing yet. It closed at 172.28, barely above trade at 172.10. Volume wasn't bad, as you can see here. No oversold, but hey, we didn't get an oversold signal on August 5th either when markets bottomed. And it came right down, as you can see, tested this trend level and bounced higher. Those are all good indicators for a probability that markets start to march higher a little bit. Now, could that go against the seasonality trend of a bad September or a bad back half of September? Yeah, all that is possible to be sure. And so we're going to be watching very carefully the S&P 500 to see, do we continue to stay above trade? Do we pop back down and test this trend level? How do the daily ranges of price, volume, and volatility on a rate of change basis shift? Will they shift higher? If they shift higher, then that gives us some confidence that for our most aggressive accounts, we could potentially add back some of that leverage and take advantage of the expectation that we get some higher moves. All that is possible. The big thing that's happening is next week, and it's the Federal Reserve deciding what are we going to do. And the expectation is they cut rates 25 basis points. I don't think a 50 basis point cut would be a good idea. They don't call me and ask me my opinion, but I think that would tell the market that, whoops, something broke. Now, something may have broke anyway, but the Fed's admission of it would be a really bad signal, I think, for markets in general. So I think we get 25 basis point cut and then probably another 25 basis point cut at the next meeting and maybe another 25 basis point cut before the year ends. Either way, declining interest rates into the end of a year cycle could pop markets higher into the first quarter of next year. And maybe this gives us a heck of a run and before it tops out. I mean, look, there are some serious structural problems in the United States today, and I think everybody recognizes that. And I don't expect them to be going away in just the next 6 months. We have a debt problem. We have a deficit problem. We're starting to have an employment problem on the edges, right? So we got to be careful of that. So Nevertheless, one day at a time, one thing at a time, and the one thing at a time right now is that the S&P 500 has broken back above trade. It stayed above trend after testing it. Volume was good. I just want to see this volatility metric start to give me some indication that prices will move higher, and that tends to happen when it rolls over and heads lower. You can see here, rolled over, heads lower, prices go up. That tends to be what that is. And again, these are just proprietary pictures of what we deal with every single day as we try to analyze markets and analyze what's happening inside global macro at the same time. Volatility, I try to mention volatility every day in my morning emails. And one of the things I try to let everybody know is that the term structure of volatility is normal for at least the front month, VX1, and the second month, VX2. That's this and this. So front month, 1745, second month, 1870. It's in a positive slope. That positive slope is what we call contango. I know, fun words, right? Which tells me that we are just in a normal relationship for volatility. What I don't want to see is front month higher than second month. I'm not worried about third and fourth month being lower than second month right now. That's not something that I get, as of right now, worried or concerned about. What would concern me in the very, very near term in terms of market health is if this thing went into what we call backwardation, where front month gets up higher than second month. And so we'll watch it. We'll pay attention to it. I write it down every day at the open, every day at the close. We continue to monitor it through our systems, continue to consider how they might affect markets along with our modeling systems and things of that nature. So jumping over to VIX real quick, you can see that it is in a bearish trend. 3 months or more, trending lower on a rate of change basis, staying below this trend level up here of 2680, staying below this trade level here of 2145. That's good. This blue line here and this blue line here that you see is a day-by-day rate of change, price volume and volatility indicator that tends to contain the movement of anything that we're looking at. In this case, volatility. So if it got down to this level, I'd expect it to pop up some. If it got up to this level, I'd expect it to drop some, right? And just kind of trade that way. So what I want to see is this blue corridor, if you will, start to roll over and just head lower. And then if it does that, it just tells us volatility is more and more contained. Volatility continues to trend lower. That usually is giving us some good price action in global markets. And so we'll, again, continue to pay attention to that day by day. Yield curve, you hear that a lot these days. Well, it's positive again, right? It's at 7 basis points. You can see it's been trending higher for a while. We've been in an inverted yield curve up until this last week for the better part of 2 years. That's a long time. Longest in history, as a matter of fact. So the fact that we've had that length of time and now we're out of it, there's all sorts of noise in the system telling you, yeah, but when that happens, recession is imminent. Recession is imminent. Well, okay. I'm not going to believe it until we see it. And I sent out in my morning email this morning something that I thought was interesting on what's called the SAHM rule, SAHM. And the SAHM rule takes into consideration unemployment. And when it ticks above a certain level, historically speaking, that has indicated beginning of a recession. Well, somebody decided they were going to look at a different cohort of employment. And they looked at it from the aspect of the 25 to 54-year-old age group. And that age group is not experiencing an increase in unemployment. In fact, they're experiencing the opposite. So that's interesting and I think important because those are the higher income earners of the cohorts of total employment. Okay, interesting. So just because the traditional SAHM rule has triggered, so to speak, I'm not so sure that we are in fact headed towards a massive recession or anything like that. Could we be? Yeah, we could. But so far, markets are not telling us that that's the case. And one thing that tells me that is junk bonds. So this is a picture of junk bonds, high yield bonds, however we want to call them, bonds whose issuers have to issue debt at a much higher interest rate, high yield or junk, because they are riskier. riskier businesses tend to really take it on the chin when recession kicks in. And so therefore, when we see a recession really starting to ramp up, high yield bonds do terrible. Well, this isn't terrible. I mean, I don't know. This chart is up and to the right. Up and to the right means better. Up and to the right, better means high yield bonds are doing okay. So therefore, I'm just going to look at that and kind of, well, move on, right? Interest rates, well, they continue to tell us that the economic cycle is slowing. Could we have a slowing economic cycle without a recession? Yeah, absolutely. We still could have positive GDP data, but on a decelerating basis. So the bond market has just given us an indication of two things. One, they expect the Federal Reserve to cut interest rates. And two, it's anticipating a slowing economic cycle. That's all it's saying. It's not saying recession, depression, blow up, market crash, or anything else. It's just telling us things may be slowing. So rates continue to be in a bearish trend, signaling lower lows over a period of 3 months or more, and it just keeps trending that way. We own 7 to 10-year treasuries. These are 7 to 10-year yields. You can see both are in a bearish trend. And for our more aggressive accounts, we own 20-year treasuries, and this is the yield for a 20-year treasury. So it's all telling us the same story. Bearish trend, bearish trade, both on a short and intermediate term cycle. Lower lows continuing to kick in for the rate cycle, but they're coming off the low end of the daily trade spectrum, which just tells me we could see a bit of a bounce. Not a big deal. It's still a bear market in rates. Bond market is still telling us it's safe to own bonds. And the reason it's telling us it's safe to own bonds is that the volatility for bonds continues to pull back and is now back into bearish trend. So I think that's a good thing. Last two things, and then I'll jump on or jump off this video and this podcast. And one of them is oil. I commented in my most recent morning email that oil continues to be in bearish trend. It's signaling a decreasing degree of economic activity or demand on a global scale. Oil is always an extremely good indicator of economic activity because you can't have economic growth without energy. And windmills aren't going to cut it. No matter who wants that to happen, it's not happening. Pay attention to oil. Oil gives you the best indicator of whether or not we are in an economic increasing scenario or decreasing scenario. And oil has been telling us the economic cycle is slowing, but it's oversold. Volatility metric has ramped to its high. It's rolled over, and we got two buy signals. So I said in my morning email, would not be surprised for oil to give us a counter trend bounce, maybe up to this $74 a barrel level. If it does that, I still expect it to fail. Now, if it doesn't fail, guess what? We think of something new. And that something new would be, maybe there's some real economic demand happening now on a global scale that has shifted. So far, that's not the case. We're just continuing to see negativity within the oil market, negativity within copper. Copper is another great indicator of economic activity. It's bearish trend. It's signaling lower lows. It's trading below its trend level, and every time it's gotten close, it's failed. This is just a picture of copper futures here. So that basically is the 30,000 foot view, maybe all the way down to 1,000 foot view of what's happening in global macro and in the specifics of U.S. equity, bond, and commodities markets. And so there's some conflicting data. There's some conflicting perspective, if you will, right? You got, on one hand, some growth happening inside equity space that suggests maybe things are better than the data is suggesting. And then you have things happening in the bond market and in commodities market that continue to suggest economic slowing. So can you have both? Yes, you can have economic slowing without a recession. Because remember, a recession would be indicated by quarters, back-to-back quarters of negative GDP. We're not signaling that, at least not based on the bean counting that goes on day over day, week over week, month over month in the landscape of economic data that would be enough to bore to tears anyone. And I don't want to do that. I don't want to bore anyone at all. So That being said, if you have any questions at all about how we're positioning, what's happening inside global macro, or what is taking place inside both domestic and foreign markets, let me know. Shoot me an email, chris@careformywealth.com. You can call, of course, toll free 866-596-9886. Or you can text or call me direct on my direct line, whatever would suit you best. I'm always open for questions. I'm a terrible mind reader. So please, if there is something on your mind and you want to chat about it, or if you want to get more detail about what we see happening and why, by all means, please let me know. Until then, I hope you have an amazing remainder of your week, a very blessed weekend, and enjoy what looks like a little bit more summer for us Northerners up here in the Wisconsin zip codes. For all of our Southern friends, grin and bear the heat, I guess, right? Okay. Won't be too long when I'll be wishing that we had that up here because we'll be steeped in snow. All right. Have a great day. God bless. Take care.